Hi guys, it's Stock Curry. Russia just threatened nuclear war and the futures are falling hard. In today's video, I'm going to show you how the markets normally respond during times of war and whether now is the right time to buy the dip or sell before things get worse. So let's get into it! Okay, there wasn't a whole lot of news coming out of Ukraine. From what I can tell, it was a pretty quiet night in Kyiv, at least. It looks like the Russian troops have actually backed up a little bit outside of Kyiv. I wouldn't say they're full-on retreating, but they're definitely backing up a little bit. Now, my concern is they might be trying to get out of, say, like a blast zone. President Putin is getting backed up into a corner. He's getting desperate. And with his threat of nuclear weapons now in play, there is some concern that President Putin might use these nuclear weapons on Kyiv or possibly some other type of indiscriminate bomb that will have the sole purpose of just killing millions of people and wiping out the city of Kyiv in one blow. So this is the concern that's going on right now. We're not really sure why the Russian troops have backed away from Kyiv, but we do have reports that they have surrounded the city of Kyiv but have backed away. Now, the good news is that the Ukraine delegation and a Russian delegation are meeting at the Belarus-Ukraine border on Monday. We'll find out what happens with that. We may get a possible ceasefire. We may get something else. I don't know. There are no known things going into this, meaning we don't really have any pretext or any idea what's going to be talked about. But the fact that the Russians and Ukrainians are talking is a good thing. So that is going to happen on Monday. And again, hopefully we get something good out of that, and praying to God that we actually get a ceasefire out of the meeting on Monday. Now, that said, the fact that Russia has actually threatened nuclear weapons, and very specifically, he made that threat in response to sanctions from the United States and other European Union nations, this is actually causing a lot of fear in both Europe and the United States. Now, of course, all of the uncertainty surrounding the Russia-Ukraine war is causing people to believe that the Fed is going to be more dovish when it comes to their March rate hike, and the CME futures are now pricing in a 95% chance of a 0.25 basis point rate hike in March, and only a 5% chance of a 0.5 basis point rate hike in March. Now, we do have Jerome Powell speaking to Congress on Wednesday and the Senate on Thursday. Both of those should be televised. So normally when Jerome Powell speaks to Congress and the Senate, he is very dovish, and generally the markets will rise as he's talking to Congress and Senate. So hopefully Wednesday and Thursday are going to be good days in the market, and the market will rise as Jerome Powell speaks. Now, we also have the jobs report, the February jobs report, coming out on Friday, so we'll have to keep an eye on that. If the jobs report is really, really good, that could allow the Fed to be a little bit more hawkish, meaning give them a little bit better chance of raising the interest rate to 0.5 in March rather than 0.25. So we'll have to keep an eye on that. Now, I also want to talk about the possibility for a recession here in the United States. Meet Kevin and a few others have talked about how wages are growing faster than inflation, and when that happens, you end up with this situation where the Fed literally has to cause a recession in order to stop inflation. Otherwise, inflation gets out of control and it very quickly becomes hyperinflation. And so this is kind of a concern right now. Now, what I showed you in a prior video was going all the way back to 1950 for the past 72 years. Every single time the Fed raised interest rates, it caused a recession within 6 to 18 months. Now, there was exactly one exception to that, and the one exception was 1952. In 1952, the Korean War was raging on. The United States had entered the Korean War, and when the United States entered the Korean War, and the United States started spending a lot of money on the war efforts, that actually gave a boost to the stock market and a boost to the economy, and stock market actually went up during that time period, and it actually delayed the recession for an entire year. So in 1952, we didn't actually get a recession for 2 years later. Every other time, though, we got that recession within 6 to 18 months. So just based upon that, a war during a time that the Fed is raising interest rates could actually delay a recession depending upon how much the US government spends on that war. Now, I should also point out that the stock market generally does very well during times of war. The stock market will typically bottom out in the days, weeks leading up to an event, and then once the war actually starts, the stock market starts going back up. Now, one caveat to this is that even though that almost always happens, it's only true if the United States is not militarily involved. So right now we have the Ukraine-Russia war, and it's a war between Russia and Ukraine. The United States is providing some supplies, some military equipment, but we're not actively involved with boots on the ground fighting Russia. And so during those types of wars, the stock market almost always goes up once the actual invasion starts. And of course, we saw the actual invasion start on Thursday. We saw the stock market in the morning take a major dip, open down over 3%. And that, generally speaking, is going to be the bottom for the market. So there's a very good chance that Thursday was the bottom for the market. Now, it doesn't mean the market's going to go straight up. We'll still probably get a zigzag on the way up. So we'll have some down days, some green days, some, all over the place. But generally speaking, it's going to trend upward. Now, the one caveat to that is it's if the United States does not get involved. Whenever the United States gets involved, you think the Iraq War, the Korean War, World War II, then the stock market will generally fall for a pretty prolonged period. Anywhere from a few months to a few years, just depending upon how long the war lasts and how long the U.S. is involved. So if the United States were to get involved in some way, say we entered Ukraine, or we attacked Russia, or Russia attacks us with a nuclear missile, or something like that, something that causes the United States to get involved in this war, then we could see the stock market go down for a very prolonged time period. But so long as that doesn't happen, so long as the United States does not get involved and it remains a war outside of the United States, then generally speaking, the stock market will rise and Thursday should be the bottom. Now, short term, of course, because once the Fed starts raising interest rates, we're going to get back to this, and we're going to have to start looking at what's going on with our own economy and start focusing on that. But at least in the short term, over the next 2, maybe 3 weeks, we could get a nice little bull run, which could be good, at least in the short term, for our stocks. Now, I should point out that stocks are not going to go up or down together. They're going to depend upon what sector they're in. There are some sectors that are not going to perform well during a time of war. And those sectors include travel stocks, for example. Hotels, airlines will generally go down during a time of war because people probably aren't going to be traveling to war zones or even countries that are near war zones. So in that case, the travel stocks could go down. But in this case, we have a very unique thing that is going down, a sector, and that is the banking sector. Banking stocks are actually getting hit right now, and part of the reason for that is a lot of people were buying banking stocks in anticipation of the Fed raising interest rates, myself included. But as it becomes less likely the Fed will raise interest rates more aggressively, that is, they will become less hawkish, more dovish, they will raise interest rates less likely or less often, then that ends up not being so great for banks, because as interest rates go up, banks will make more money. But if the Fed doesn't raise interest rates as fast, the banks aren't going to make money as fast. And so there's no reason for the stocks to go up quite as fast. And then, of course, we also have fears of a cyber war against our banks, which might take our banking system offline. And so that also will cause continued uncertainty in the markets and will help keep banking stocks down, at least in the short term. Now, of course, there are other sectors that benefit during times of war. One of those is energy stocks, especially oil. Oil will go up during times of war. And we've already seen that. Oil was up over $100 a barrel. It actually came down over the weekend, but then as soon as Putin started talking about nuclear war, the oil futures rose back up. They're up about 6% right now as of the recording of this video. And then the other sector that's generally going to do quite well during times of war is, of course, our defense stocks. Think stocks like Lockheed Martin, which is LMT, Northrop Grumman, NOC, and L3 Harris, LHX. Those are some of the defense sector stocks that should perform quite well, especially if the United States actually enters and gets involved in this war. Now, there is one thing I do want to say about oil real fast, and that is that a lot of the rise in price in oil has already been factored in, especially since Russia has already invaded Ukraine. So I don't necessarily think it's the right time to buy oil stocks right now. I think the time to buy oil stocks was weeks ago when the initial buildup was occurring. At this point, with oil over $100, I would not be buying oil. I think it's too late. The other thing I want to talk about is cryptocurrencies. A lot of people have been asking me, is it a good time to invest in cryptocurrencies? Now, this, I think, comes from some confusion that a lot of people have been told that cryptocurrencies are a store of value, much like gold or other assets. And unfortunately, at this time, that's just not true. Cryptocurrencies have generally been following the stock market. As the stock market falls, we've seen crypto fall. As the stock market goes up, we've seen crypto go up. So unfortunately, crypto is not that store of asset that people hoped it would be. If you're looking for a store of asset, you definitely want to be looking at things like gold and silver. Those are far better stores of asset. And in fact, once Russia started talking about nuclear war, we actually saw gold prices go up about 1.5% to 2%, which is, you've got to understand, pretty significant for the gold market. Gold generally does not move that much. I mean, a big movement in gold would be like 0.3%, and we're seeing it go up almost 2%. That is a massive move upward for gold. Now, it should also be good for our gold stocks. Hopefully it is. We'll see. The other thing that I want to say about cryptocurrencies real fast is, generally speaking, if you think the stock market is going to go up, you might want to invest in crypto because crypto will generally go up faster than the stock market. But if you think the stock market is going to go down, then you probably want to pull out of crypto because crypto will fall faster than the stock market. So the thing about crypto is almost like a derivative where it moves along with the stock market, but it moves a lot faster than the stock market. It goes up a lot faster, but it also goes down a lot faster. Okay, let's talk about earnings this week because we do have some big earnings coming out this week. This week, man, there are a ton of retail-heavy stocks, these so-called meme stocks that are reporting earnings this week. So let's go look at what stocks are reporting earnings this week. Now, Monday before the open, we've got Berkshire Hathaway and Lordstown Motors. But after the close, we've got Lucid, Zoom, and Blink. But then check out Tuesday. Tuesday before the open, we got Target, but then after the open, we've got SoFi, AMC, Plug Power, Salesforce, Wish, Bionanogenomics. It is going to be a huge day for retail investors Tuesday after the close. I expect major market movements in the small caps. Then Wednesday before the open, we've got PaySafe. And then after the close, we've got Snowflake and ChargePoint. And then Thursday, we have Best Buy. And then after the close, we've got Marvel, Costco, and then not really a whole lot on Friday. So just keep in mind that this is going to be a major week for earnings for retail investors. A lot of retail popular stocks, the so-called meme stocks, are reporting earnings this week. So keep your eyes on earnings this week, especially Tuesday and Wednesday after the close. Okay, now if you guys have been following me, you know that I purchased a call option near the market close on Friday. If you didn't know that, you can follow me on Twitter at twitter.com/realscottcurry. I post all of my trades on there free of charge within minutes of buying or selling anything. It's up there on Twitter. And then if you want to know my reasoning why I buy or sell something, you can join the VIP Discord. In there, not only do I tell you why I'm buying something, but I actually post my buys before I actually place the trades so that you can get in on the trades also. If you're interested in that, you can go to stockcurry.com/coaching where you can sign up for the VIP Discord. Now, just so you're aware, the futures right now are down between 2 and 3% as of the recording this video. And a lot of people have been asking me if I'm concerned about the futures being down, especially since I just bought a call option on Friday. And the answer is no. And that's for a couple of reasons. First of all, when it comes to the futures, you've got to understand the futures are a guessing game. They don't necessarily point to how the market's actually going to open. I have seen the futures up 3%, and then when the market opens, it's opening down 1%. I've seen the futures down 3%, and then the market opens up 1%. The futures don't mean anything. They're just a guessing game on how the market's going to open. So if you are looking at the futures, it's fine, it's fun, but really what we want to look at is the stock market. Now, even if the stock market opens down on Monday, let's say just for an analogy, it opens down 3%. What will normally happen is when the market opens down, it's going to create what's called a gap on the technicals. And the gap will normally get filled. Now, what that means is whatever the market opens down at will generally rise back up, fill that gap. And so if the market opens down 3%, about 80% of the time, that gap will get filled within 3 days. So if we do open down 3%, 80% of the time, we're either going to get back up to where we closed out on Friday on Monday, or we will get back up to where we closed out on Friday by Wednesday at the latest. So I'm not really concerned about my call option, since I know I have an 80% chance of the stock market rising back up, filling the gap, and I can at very least sell it and break even. Now that said, I'm also not concerned because I bought the call option from March 18th. And the reason I went that far out is 2 reasons. Number one, the further out you go, the less theta decay you get. Now, if you don't know what theta decay is, it's basically time decay. So as an option gets closer to expiration, it loses value faster and faster and faster. But if you get an option that's far enough out, you don't lose a lot of money to the time decay of that option. So it actually makes the options more valuable if you buy them further out. The second reason I went for the March is so that I could overcome some of these short-term fluctuations and market volatility that we're getting. Remember, based upon my analysis on Friday, I felt like the markets would go up. And because of that, I bought the call option. Now, that doesn't mean the markets are literally going to go up every single day. There's a lot of short-term volatility where the market might go down 2% one day, up 3% the next, down 4% the next, up 5% the next. We don't know. But there's a lot of market volatility, so I don't know what the market's going to do day to day, but I can look and try to make some predictions on what it might do over a week or a month. And so based upon that, I'm thinking the market will go up, but I don't know what it's going to do day to day. I didn't want to get stuck with a weekly call option where maybe the market goes down this week and doesn't actually start rising until next week. And then I'm screwed and I lost all my money. So that's why I went for the March 18th option. The longer out you go, the less money you're going to lose if the trade goes against you. You also have more time for the trade to turn around and go back up, and you lose less money that they did decay. So if you're buying a single leg call or put, if you're buying a single leg option, if you're in Webull, this would be options trading level 2. If you're buying a single leg option, then try to get them as far out as possible in what's known as leaps, or long expiration dated options. And the longer out you can go, the less volatility you'll get from these day-to-day fluctuation, and also the less time decay you'll get, and the more time you'll have for your trade to turn around if it starts to go against you. So that's my advice if you're looking to trade single leg options, is try to get the date out as far as possible, as much as you can afford, of course. Now, the final thing I want to go over is what could cause the markets to go up or down over the course of this week, or say the next 2 weeks, and specifically looking at what news could come out that could cause the markets to move. I've already talked about how Jerome Powell is going to be speaking to Congress on Wednesday and Thursday, and that could cause the markets to most likely go up. I've also talked about the jobs report coming out on Friday. But overall, as far as the world news, what I see is inflation is already priced in. The Russia-Ukraine war is already priced in. I mean, Russia already attacked Ukraine. That's priced in. The interest rate hike in March is already priced in. So really, the bad news is already priced in. There's really not a lot of bad news that could come out that could cause the markets to go down. However, I do find 3 things that could cause the markets to go down if this news were to be reported. The first one would be the Fed raising interest rates by 0.5 basis points in March instead of 0.25 basis points. If that happens and we get twice the interest rate hike that we're expecting, well, that could cause the markets to go down. The second thing I see that could cause the markets to go down would be if the United States were to somehow enter the Russia-Ukraine war militarily. And so if we maybe send troops into Ukraine, if we directly attack Russia or something like that, that could cause the market to go down. And the third thing that I could see that could cause the market to go down is if Putin actually uses nuclear weapons. So if any of those three things happen, the market will more than likely drop. But so long as none of those three things happen, which right now it doesn't look like they will, then the market should continue to rise regardless of what the futures look like right now. Oh, and one more thing. Please do not confuse my short-term bullishness for my long-term bearishness. I remain long-term bearish on the market. I still think that inflation is going to rise. It's going to continue to put downward pressure on the markets. I still think the Fed is going to have to raise interest rates a lot faster than they would like to, which is also going to put downward pressure on the markets. And I still think the Fed is going to cause a recession, which is going to put downward pressure on the markets. So I remain long-term bearish. Please don't get that confused. I am short-term bullish, long-term bearish. So my bullish thesis that I've just laid out for you guys, 2 weeks, 3 weeks max. After that, I'm bearish once again. All right, I thank you guys so much for joining. I hope you got a lot out of this video. Go ahead and comment down below what you think the stock market is going to do this week. Do you think it's going to go up, go down, trade sideways? What do you think the stock market is going to do this week? And just a reminder, if you want to sign up for Webull, they are offering now 2 free stocks worth up to $2,300 if you sign up using my link in the description below and deposit just $1. Also, if you are not a U.S. resident or if you are looking to trade OTC penny stocks, then you can sign up for Interactive Brokers. Interactive Brokers has highly discounted trading. Trade strategies $1 US, $1 Canadian dollar, 4 euros, or 6 Australian dollars, depending upon where you live. And both Webull and Interactive Brokers also offer the full pre-market and after-hours trading from 4 a.m. till 8 p.m. Eastern Time. Now, I do want to remind you that I have material connections with both of those, so whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Finally, I do want to remind you to go ahead and hit that like button and subscribe, and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.